In the second part of the conversation, Prashant Jain shares valuable investing lessons and ideas for wealth creation. That's so true, because we've seen this actually happen. Take PSUs, for example. I think at the time, a lot of questions were asked by unit holders about why you're not participating in many of the growth pockets. And now it's for everyone to see. I mean, the way PSUs have rebounded, many are very optimistic about the kind of momentum they can sustain in the coming time. Are you still holding by these bets? Do you think there's more on the upside?
People have not looked at PSUs the right way. See, there are good and weak businesses both in private sector and in public sector. Whether the business is public or private is important, but what is more important is whether the business is sustainable or not. So I think I was careful to buy only the sustainable, well-managed businesses that are competitive in the marketplace. One thing which markets have ignored is that almost all PSUs are in core areas of the economy. So there are no PSUs in FMCG or pharmaceuticals or IT. So when the economy goes into a downturn, like what happened in COVID periods, banking is hit, commodities are hit, mining is hit, power is hit, capex is hit. And these are the sectors where PSUs are there. So if you look at now PSUs as a basket, you will get an impression that all PSUs are not performing. But the fact is, the core areas of the economy are not performing. There are good and bad PSUs, and when you buy a good PSU below intrinsic value, I would not hesitate to buy it. In fact, if I may go a step further, in PSUs it is very easy to take a view of the future. Yes. Because they stick to what they are doing. See, a more enterprising business house, company in the private sector will try and do new things. So they may or may not do well, but in PSUs, they generally stick to what they do. So to that extent, to estimate the future is actually easier, and you simply have to focus on the value. So I think bulk of the undervaluation in banking, in power space is gone. These are not expensive businesses, but I think the chances of a re-rating are limited. Not just here, but for the broader markets in general. And I think returns should be moderate over time and in line with the growth of the underlying businesses.
Speaking about power stocks, do you think that the entire focus on ESG investing will perhaps shift the way these companies are perceived and rated?
So ESG, I think the way it has been debated, discussed and practiced, I think was not right. Because it was not grounded in reality at all. People even avoided tobacco. You were talking of PSUs, but look at what happened to tobacco. What happened to oil globally? The same United States, which was saying, let's not drill more on shale oil. Now they are pushing those companies to drill more oil. So I think ESG, this exclusion-based investing, will not achieve much to my mind, because the needs of life are very real. And try telling someone that energy is not available. And so I think the answers to ESG have to come from laws, they have to come from technology. And I don't think exclusion-based investing, simply not investing in tobacco or thermal energy or defense equipment companies, I don't think it makes any sense. And therefore I would say this was one more instance of how majority opinion can get it terribly wrong in equities. It happened with technology in 99-2000. It happened with real estate in 2007. And this time it was this. The majority opinion is more often than not wrong in equities.
So what are some pockets where you see scope for value creation at current levels?
Most of the value creation in India will happen because of accelerated economic growth in India. India's economic growth prospects, to my mind, are the best that I have seen in my 3 decades career. What COVID has done, it has made remote working acceptable. And US, Europe, China, Japan are aging. Less US and more the other countries. So they are experiencing a falling working age population. And remote working is now acceptable. So I think a lot of services will move to India. The jobs will move to India. Not just IT and BPO, but maybe accounts, taxation, HR, payroll, engineering, back offices, all kinds of things. And this is very timely for India because India's working age population will grow rapidly in next 2 decades. So I think this offshoring of services will create a lot of jobs. I think simultaneously India has gained competitiveness versus even China in manufacturing. Our manufacturing wages are now half of China. And the world wants to de-risk because of lockdown challenges and also because of geopolitical reasons. So I think for the first time in modern history, a country will experience, to my mind, a growing share in both services and manufacturing. So I think India's real growth, which has averaged maybe 6% last 20 years, should move up higher to maybe 7 or 8% for next decade or two. And I think that is the biggest source of wealth creation because equities over time deliver returns in line with the underlying growth of businesses. Coming to sectors, most of the low-hanging fruit, the re-ratings, that is to my mind behind us. Okay. One can still argue for some small re-rating in some banks in the power space, but I think 80% of the re-rating in those pockets is done. And that's why my view is that next medium to long term returns should track basically the business, the earnings or the economic growth rates.
What do you feel about the earnings cycle? Do you think the momentum will pick up?
I think the normalization process of earnings has already taken place, and if you recall, India's profits to GDP had fallen to 1% 2 years back, and driven by weak capex and NPA challenges of the banks. Today, profits to GDP is between 4 to 5%. And because of that extremely low base, profit growth has been very healthy last 2-3 years. I think going forward, we should not expect profits to outpace the top line growth rates. So I think most sectors are now decently profitable. Margin upsides are very limited to my mind. So I think earnings growth should broadly track rupee GDP growth now onwards.
Let's talk a bit about the US economy. Inflation is a big problem. The US Fed has announced a series of rate hikes, and that looks likely to continue in 2023 as well. How do you think this will pan out for the global economy? And specifically, what impact should Indian markets brace for?
So, to be honest, I am not an expert. I am neither an economist nor an expert on US, but I do read and think and discuss. So I think the inflation in US will settle higher than where it was pre-COVID because of two reasons. Last 2 decades you had the tailwind of importing deflation by way of rising share of Chinese imported goods. Export prices out of China are not coming down because China itself, the peak demographics is behind them. Wage inflation is good, high in China. That tailwind has become a headwind. So I think US inflation and interest rates, to my mind, should settle higher than the pre-COVID levels. Second, we have to grapple with the tapering. It's a massive monetary stimulus last 2-3 years. 4-5 trillion of Fed balance sheet went up to 9 trillion. And the tapering, how markets behave when you start sucking out liquidity, I'll be very keenly watching, but we have very little experience of situations like this in the past. As far as India is concerned, I think the correlation of India's economy with the world economy is a weak one over the medium term. Markets have displayed a tendency of high short-term correlation with the Western markets, especially in panic or crisis type of situations. So that cannot be ruled out, but those corrections are always unsustainable and there are always opportunities to invest. Interestingly, last time around when foreigners sold almost 40 billion between I think September 21 to June 22 probably. The locals slapped it up because locally the flows have been quite strong. So I'm not sure whether when the next time such a crisis comes worldwide and markets fall in unison, whether we'll have equally deep corrections as we have had in the past.
Speaking of this, just to take your point a little forward, with the rising cost of capital in the US, do you think it's going to puncture the growth momentum in many sectors of the economy? Take the new economy, for example. Many of them were riding this wave. Do you think that this kind of brings the spotlight back on value investing versus growth investing, or what you call as growth at any price? Do you think that it's going to shift a bit?
No, I think I think it will happen as cost of capital normalizes. Businesses, as capital becomes more expensive, as it becomes more demanding, I think models which were not sustainable, which were relying on constant burning and increasing amounts of cash burn, I think they will clearly come under challenge, and also excesses in the capital markets where markets were pricing in massive and in most cases very unreasonable amounts of growth. I think those will also get impacted.
How do you see the markets being influenced in the next 6 months? I know it's a very short-term period to be talking about, but just to get a sense.
While it is extremely hard to forecast markets near terms, it is not even important because you can see how Sensex has created wealth, and along this 40 years there have been many periods of 5, 10, 20% correction. But I still feel that next 6 months is important because the impact of US tapering, the US inflation, interest rates will play out. The US is the largest economy, it's the largest provider of capital, and when liquidity conditions will become tighter there, I think that is something one should take note of. And because valuations in India, while they are not unreasonable, they are neither attractive. And also in 6 months' time, we will move to fiscal 25. The markets will start pricing in fiscal 25. And based on that, I think the risk reward will start looking better. So I think next 6 months, maybe it's not the time to go all in for equities. Keep some money on the side, and once either time or price correction has taken place, I think the risk reward even in the near term would improve more. So I think in an environment like this, when you are faced with this big change, I think it would be prudent to keep some money on the side. So I am not saying over 3-5 years these markets will not create wealth, they will. But and someone can invest all of it also. But I still feel on balance that something for future allocation to equities should be kept.
So tell us a bit about your new venture.
No, it's a very small setup, and we will be fully focused on building a good investment culture, a good investment team, and we'll follow the same principles of investing that have helped me and those funds in good stead for 3 decades. But this will be a more niche business, and we hope to start off with an AIF. At least initially, I don't know about, we haven't thought this through, but initially the focus will be at the top end of the market.
So you are in a profession where there's a constant need to outperform peers, outperform the market. How do you cope with the pressure and reboot when required?
To be honest, I have never felt unreasonable pressure. I think in every profession we tend to compete, and so this peer group performance is not unique to this industry. In your industry also TRPs are there, right? So I think even in sports it is there, in media it is there, in movies it is there all across. I try and focus on doing my best, and I cannot be focusing on what others are doing, because that will further reduce my chances of doing well. And I am focused on delivering good absolute outcomes in what I am doing. And someone may be better, someone may be behind. That is neither in my control, and nor does it really matter. But of course, an active manager, I think, is very important that you are able to generate value over the benchmark. So that is a keen objective and a desire that, or a benchmark that I set for myself, that I should try and add value over the benchmark. And I have no specific desire or objective to beat peer groups. But longer term, I feel that if you beat the benchmarks longer term, you will be at the top of the peer group also. Because as is very clear today, a majority of active managers have failed to even beat the benchmarks. And this is probably a result of, trying to focus a lot on the short term.
So do you meditate? I've never seen you agitated. You
I
are
do,
very calm,
I do
centered.
meditate. No, I do meditate every day, yes.
It helps you clear your mind?
I don't know what is the cause and effect, but I am sure meditation does not do any harm to you. So I think it is always good.
What's on your reading list for 2023?
So it's a very long reading list and time is less, so I keep on reading. I have just started a book yesterday. I think I forget the title, about the last 200 years of British economy. Industrialization started in late 18th century, and UK was the first to industrialize. So by reading that, I think it will give me a good perspective of how probably that economy has evolved, and I am also hoping it will give us some insights here how manufacturing has moved around the world, because I have not been able to find any book on that so far.
Sir, thank you so much
No,
for your
pleasure,
time.
pleasure, Neha.
I'm so grateful that you shared your experience with us, your investing mantras with us. Thank you so much.
My pleasure. Thank you.